Hi, this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, September 13th, 2024. The economic news just keeps getting better. 2 days ago, we learned that the Consumer Price Index rose 0.2% in August and increased 2.5% over the past 12 months. That was its smallest annual gain since February 2021. So here's that report, and I have a link to it in the article. And you see up here in the upper right-hand corner, this is the all items, which includes food and energy, trailing 12 months up 2.5% and just 0.2% in August. You'll notice earlier in the year it was rising by 0.4% in February and March and 0.3% in April, but since then it's really slowed down. So that's good news as far as inflation goes. Now, more good news on the inflation front arrived this morning in the form of a 0.3% decline in import prices last month. That is its largest drop since December 2023. Since import prices ultimately get passed along to consumers, that is one more data point that suggests inflation is under control. So here's that report, and it's kind of hard to see this chart, I realize, but if you click on the link, you'll be able to blow it up and take a closer look at it. But nevertheless, that's also good news as far as inflation goes. Now that sets the stage for next week's meeting of the Federal Open Market Committee. As I said a week ago, at this point, there is no doubt on Wall Street that the FOMC will decrease its policy rate on September 18. The only question is if that reduction will be a quarter point or a half point. As I also said last week, I believe the FOMC will reduce its policy rate by a half point when it meets later this month. Now, this week's economic data reinforces that opinion, as does the reaction by the bond market. Since the start of this month, the yield on the 10-year Treasury note has fallen from above 3.9% to below 3.7%, and I'm going to show you here that year-to-date chart. You can see the yield on the 10-year Treasury note peaking, really last October, and then as far as this calendar year goes, peaking in April, well above 4%. But since then, big drop down, especially since the end of August. The stock market is happy with that news too. Since dropping below 5,500 a week ago, the S&P 500 index is back above 5,600 and only 1% off its all-time high achieved 2 months ago. Now, here is the year-to-date chart of the S&P 500. You can see the big drop in late July and early August when it looked like a recession might be forthcoming. But you can see where it really took off here, and that's when that retail sales report for July came out, which indicated consumers are still spending. Then another drop here before the inflation news come out, but we're very close to the all-time high. Now, just as importantly, the equal weight version of the index is also surging and is very close to establishing a new all-time high. So again, the regular S&P 500 index is cap weighted, which means the biggest companies, almost all of them, the big tech companies, dominate its performance. But in the equal weight version, all 500 companies have an equal weight, and that's also about to set a new all-time high, which means Wall Street is buying stocks of all sizes and in all sectors. Now, despite the dire warnings from politicians and the news outlets that amplify their messaging, the simple fact of the matter is that the U.S. economy is on solid footing. And if the FOMC does cut its policy rate by half point next week, that will go a long way towards reducing unemployment. So that raises the question, if the stock market climbs a wall of worry, what are we to worry about now? Certainly, food prices are too high, but that has not yet adversely impacted retail sales and other consumer behavior. And here's the St. Louis Fed's tracking of food prices. And you can see, although they've really leveled off here during the past year, 2021, 2022, in the aftermath of the supply chain disruptions and increase in commodity prices that drove up food prices, they've leveled off, but they haven't come down. Also, mortgage rates are twice what they were 3 years ago, and I'm going to pull up that chart for you here, also from the St. Louis Fed, so you can see what that looks like. They're coming down, However, they are coming down now and are at their lowest level in 2 years. And if the FOMC does cut its policy rate by a half point next week, I expect to see mortgage rates come down some more. Now, I don't know why it's not showing me this, but in any event, wants me to open link? No, let's not do that. I'm sorry. Here, let's go to this. This will hopefully work a little better for us. Maybe not. Okay, well, so much for that. But nevertheless, the chart would show us that rates are coming down and still higher than where, here we go. So here's the 30-year average mortgage rate in blue, and you can see it peaking over here, where is that, October of a year ago, 7.8% nearly, but coming down Again, still a lot higher than they were before the pandemic, but now heading in the right direction. So in short, the overall direction of the economy is positive, which bodes well for the stock and bond markets. While there is always the possibility of an unexpected development that could send the bulls on Wall Street into hibernation, at the moment there is no empirical data to suggest something like that is imminent. And that's this week's PF video update, and I look forward to talking to you in another week. Thank you.